In the past, when there has been a problem with the dollar relative to gold, various agencies have stepped in and suppressed the price of gold and taken the panic out of the market. So why they're not doing it this time? Well, I think the answer is basically nobody has got gold in order to sell gold and buy dollars. They're not there anymore. And it's that combination basically which is driving the price of gold. This is leading into a very interesting situation. But the reason really that we see the price of gold rise is we're looking at it by standing on our heads. We're looking at it completely the wrong way around. It's our currencies falling.
The U.S. dollar's status as the backbone of the global financial system is under pressure, according to financial analyst Alasdair Macleod, as major holders of U.S. Treasury securities like China and Japan diversify their reserves. Demand for the dollar has decreased, causing its value to drop. This has strengthened gold, which is recognized as real money globally. Several factors are driving this shift toward gold and away from the dollar. Macleod points out that the U.S. government's debt trap and rising interest rates are eroding international confidence in the dollar. This has led investors to seek the stability of gold, which tends to retain value during economic uncertainty. This sentiment shift has broader implications for global currencies. Because the dollar has long been the anchor of the world's reserve currency system, its decline affects other currencies, often causing them to fall even faster. This interconnectedness means that investors and policymakers are closely monitoring these developments to assess their impact on global financial stability.
Yeah, I know the answer. It's actually very, very simple. I wrote a bit on my Substack, to sort of just make this clear to people what is actually going on. What you have to understand is that in any transaction, there is an objective value and a subjective value, right? The objective value is always in the medium of exchange. So if I'm going to sell you something, the one thing we agree in terms of value is the medium of exchange, whether it's dollars or pounds or whatever it might be. The one thing that we argue over is the value of what I'm selling you. You might want it cheaper than I want to sell it to you, and we negotiate, we end up with a price. The subjectivity in the transaction is entirely in what I'm selling to you. Yeah? I think that's easy to understand. Now, if you look at the relationship between gold and currency, we assume that the objectivity is in the currency. In other words, we say that gold has risen from $2,000 to $2,400 or whatever. What we're saying is that we regard the dollar as objective and the price of gold as being subjective. But this is entirely wrong. Now, dealing in our own currency, we account in our own currency, and we're always going to look at it that way, that the currency is the objective value and the gold or whatever it might be is the subjective value. But put yourself in the shoes of a foreigner holding dollars, for example. What is objective and what is subjective? He knows that legally money actually is gold, and the variability in value is in the dollar. So actually this turns the relationship upside down from what we domestic users of the dollar, if I lived in America, in my case it's pounds, obviously, it turns it upside down. From the foreigner's point of view, their choice is, do they hang on to money or do they hang on to dollars? And so what we're looking at is the relationship between are dollars being sold or is gold being sold? Do you see what I mean? So in effect, what the foreigners are now doing is they look at the US situation. They see the government in a debt trap, which basically means that interest rates are going to rise, which again means that the whole economy is going to be completely slaughtered. So from their point of view, they don't want to buy dollars. Now, I'm not saying they necessarily sell dollars, but the fact that they just don't buy dollars and they might accumulate a bit of gold means that the relationship between gold and dollars is such that the dollar is sinking against gold. And that's actually what's happening. It's not that gold is rising, it's the dollar is sinking. And the dollar, of course, is the most important currency because we have a dollar-based reserve system. The whole thing is fiat. Anything that undermines the dollar is going to undermine the value of everything else, measured in real money, which, of course, internationally is gold. So this is an interesting situation. This is really telling us that the foreigners have slowed down at the very least, or stopped buying dollars at the pace at which they have in the past. That is why the dollar is going down. Now, you can see that with the way the debt trap is developing in America, you can see that foreign central banks, particularly China and also Japan, who are the two biggest holders of US Treasuries, either are not in a position to buy US Treasuries. In Japan's case, they've got a currency which is tanking, and what they want to do is they want to support the currency. And you support the currency, how? You sell dollars and you sell US Treasuries in order to buy yen. So, the Japanese are out of it. So where's China? Well, China has been doing exactly what I've just described, except we think it's the other way around. China has, according to us, has been buying gold, adding gold to the central bank's reserves, PBOC's reserves. But it's not buying gold, it's selling dollars. That is the key. If you understand they're selling dollars, then you can see everything begins to fall into place. Now, the other thing you've got to look at,
In today's news recap, silver may have the power to reach the $30 per ounce milestone after its 26% surge in March-April on the back of gold's record run and copper's strength, even though analysts say the metal is ripe for a technical correction. Silver, both an investment asset and an industrial metal used in electronics and solar panels, may also find it hard to hold on to $30 without a recovery in global manufacturing activity and investment demand from funds. Silver is starting to behave much more as a precious metal than an industrial metal. There has been a dramatic fall in the gold-silver price ratio since the start of April, and from the technical point of view, the market may see a correction, but there is still considerable momentum, which means it could still hit $30. The gold-silver ratio, denoting how many ounces of silver 1 ounce of gold can buy, is used by the market to gauge future trends as it indicates silver's current performance against its historical correlation with gold. The last time silver hit the $30 price level was in February 2021, but sustaining it for an extended period has eluded silver for more than a decade. Investment demand for silver could help to push prices to around $32 in the second half of 2024. On the fundamental side, the silver market faces the fourth year of a structural market deficit due to expectations of higher industrial demand in 2024, Metals Focus said in a research produced for industry body, the Silver Institute. But uncertainty over the global economic outlook, especially in the electronics sector, which is crucial for silver's industrial consumption, could constrain the metal in the near term. Now, we'll show you the best clips of Rick Rule's latest interview, but first, subscribe, and turn on notifications so you do not miss out on our daily videos.
In the past, when there has been a problem with the dollar relative to gold, various agencies have stepped in and suppressed the price of gold and taken the panic out of the market. So why they're not doing it this time? Well, I think the answer is basically nobody has got gold in order to sell gold and buy dollars. If you look at the situation of the bullion banks, they are so long dollars and so short gold, they can't go short anymore because you know, they're getting into financial difficulties. I mean, if you look at the short position on COMEX with the swaps, which is mainly bullion banks, we don't know what the position is in European banks which offer unallocated gold accounts, because an unallocated gold account is basically a fractionally reserved gold account, which basically means that at the end of the day, the bullion bank is short of gold. So, the whole of our system is short of gold. The only stuff that's coming out is from ETFs. And I guess that's slowing down a bit too. So you can see that this is leading into a very interesting situation. But the reason really that we see the price of gold rise is we're looking at it by standing on our heads. We're looking at it completely the wrong way around. It's our currencies falling. And I tell you, the foreigners understand this in increasing quantities. So this mechanism is going to increase the pressure on fiat currencies in the coming months, which will be reflected in a fall in the value of fiat currencies, measured in real international legal money, which is gold. And the other aspect is, I mean, there's a fascinating thing, which is a chart which I replicated on my Substack article on this. I was speaking at a conference in Zurich last week, and one of the speakers was Ruth Crowley, who is the CEO of the LBMA. And she showed a very interesting chart. The volumes of various paper markets. I mean, the LBMA, this was an average daily turnover in March, came out at something like $95 billion equivalent. Now, COMEX it looked like COMEX was roughly 2/3 of that, or possibly 70%. Now, this is a big change because in the past, the rule of thumb was that the forward market and the LBMA was anything between 8 and 10 times the size of COMEX. But here we see the LBMA presenting a pie chart slide, which indicates quite clearly that the forward market, certainly relative to the COMEX, has actually contracted very, very substantially from that 8 to 10 times level. It's now, 1.5 times COMEX. So what this tells us is that the people who would normally short gold, if you like, in order to control the price or benefit from the higher prices, whatever, however you like to put it, they're not there anymore. And it's that combination, basically, which is driving the price of gold. And as I say, the more people understand that it's not gold going up, but fiat currencies going down, the worse it's going to be for fiat currencies. And eventually, the end game is when people in America, for example, the domestic market begins to realize that it's not gold going up, but it's their currency going down. At that stage, everybody starts getting the hell out of credit. So I think this is the beginning of something which is actually going to deteriorate very, very rapidly, probably a lot more rapidly than we think. Currency system. Okay. So the dollar is the king rat of currencies. I mean, that's the way I'd put it. So there's a film called King Rat, actually, about Singapore. I don't know if you ever saw it, about the Japanese concentration camp in the Second World War. So this is the king rat of currencies. And everything else is going to be relatively weak against the currencies, with a few exceptions. I mean, you could make an argument, say, for the Swiss franc or something like that. But basically, everything else has got a problem. The dollar goes, the rest go, and they go probably faster, most likely faster. The reason this happens is actually very simple. When you have a fiat currency, its value doesn't depend on anything more than the faith in that currency. So if you start losing faith in the king rat, then you can see that the faith evaporates quite rapidly in virtually every other currency. I'll give you an example. If you look at a currency which has, the King Rat at the moment has debt to GDP running at something like 130%. The budget deficit is currently in the region, on my estimate, admittedly, is going to be in the region of about 12% of GDP. Now, that's bad news. That's very bad news. That's King Rat. Okay. Now let's take another currency, which we'll call X. This currency, debt to GDP, 22%. Personal taxes. Oh, also the budget is in big surplus. If you look at the private sector, taxes, private taxes are around about 13%, increasing to a maximum of 15%. Corporation tax about 25%, so that's quite normal. Now, under those circumstances, I would suggest that that currency should perform a lot better than King Rat's. But actually, I've just described the ruble. Would you buy the ruble? No, nobody would buy the ruble. Well, don't be silly. You don't buy the ruble. You've got no faith in it. That is the key. It's the faith in the currencies. And when the faith disappears in King Rat, it will disappear in virtually all the others. I think the only one I would single out is probably the Swiss franc, which still has this sort of semi-mythical, stability. And, okay, so the King Rat, the only thing King Rat can do is raise interest rates to try and protect itself. It's sort of, the foreigners will be dishing out the equivalent of rat poison, and King Rat, will be raising rates through the roof. And what does that do to everybody else? I mean, it just breaks everybody else. Can you imagine what are they going to do in Japan? What's the Bank of Japan going to do with its interest rate stuck at zero? I mean, what's it going to do to its commercial banking system, which is very highly leveraged? I mean, it became very highly leveraged because of negative interest rates, which compressed credit spreads hugely. Credit spreads were virtually non-existent. So how does a bank maintain its profits under those circumstances? Well, it increases its leverage, and it should come as no surprise that the leverage in the major Japanese banks is in the order of over 20 times. I'm looking at balance sheet assets to equity. Same in the ECB with the euro. I mean, we're looking at interest rates potentially rising in King Rat to the point where it actually destroys other currencies.
Thanks for watching the video till the end. Now watch this one because it's a perfect fit for you. I see you on the other side.